The name's Bond. I know you probably think I've lost my edge or that I've gone crazy. But let's think about this carefully for a moment. There are three major stages in a cycle, and I've described these in great detail in my last book, The Rise of America. The first, the boom. The second, the bust. The third, the echo. Now let's start with the risk on, which is the boom phase. This is reserved for times when the economy is exiting a recession and during strong periods of economic expansion, just like what we have witnessed since 2009, minus the pandemic. The second being risk off, which is the bust. This is when the economy has peaked, inflation has begun to rise, and the central bank has begun to raise interest rates. Stocks and bonds get crushed in this environment. This should sound familiar, as this is precisely what has happened over the past 9 months. And the third is the echo phase, which I also nicknamed pay me to wait phase. This is the in-between stage. Equity prices have retreated, but there's perhaps further pain to come. Inflation is still high, but there is a speck of light at the end of the tunnel. I believe this is where we are now. Value investing gets rewarded during the echo phase. It's a fine line between the pay me to wait stage and the risk on stage. This gets muddled further these days as the stock market tends to be very forward looking. This means it will attribute little value to short-term problems and focus attention on the rosier long-term picture. Under this forward-looking environment, we'll likely see equity markets bottom months in advance of the total economic recovery. I believe we're getting very close to the echo phase. The Federal Reserve continues to push the narrative of higher interest rates and weaker economic growth. I believe this is done on purpose to specifically combat the market being so forward-looking. One of the best historical comparisons to this, I believe, is the 75 to 80 time period, the Fed's worst nightmare in a double burst of inflation. Now, what does that mean? If you look at the table that we've created for you here, this is the US CPI, the Consumer Price Index. That's a quarter-over-quarter percent change. If you see in 75 and 80, your first inflation burst was around that 75 frame. They thought they were going to defeat it, and then it came back in the early 80s. If that happens again, that's something that Jerome Powell is on his mind. As you can see, the double burst ended in an ugly fight where rates went to 20% the last time this double burst happened. An interest rate of that magnitude would be catastrophic for a world that has gorged itself on cheap debt for a decade. Do I expect that? No. But the markets are barely accepting 5% interest rates. I outlined in previous editions of the KRO, that's the Catoosa Resource Opportunities, that the bond market has faced enormous losses last year. Higher interest rates combined with expectations for higher inflation and heightened uncertainty of inflation led to collapse in bond prices. There you can see it right here. But what you need to really pay attention is that red line is the long-term US bonds. Those are 20 plus. Look at the high yield, the blue line, and then the investment grade. Did you catch that? Drilling into high yield. If you take a close look to the chart and notice something strange, high yield bonds are down less than investment grade bonds and the US government bonds. That's something that would be in a Twilight Zone episode. Why is that? In large part, this is due to the interest rate sensitivity of the bond. Longer-term bonds have greater price sensitivity to interest rate changes than shorter-term bonds. Not to be confused with the length of time. A bond's duration measures the price sensitivity to a change in interest rates. The higher the duration, the greater the price change sensitivity to changes in interest rates. The lower the duration, the smaller the price change sensitivity to changes in interest rates. It's all about rate of change. Back to calculus class. This hiking cycle is not just impacting the equity markets. The bond market has experienced an incredible shakeout because of the interest rate rises. This has made for one of the worst returning years in the bond market ever. This US investment grade bond market is currently worth approximately $25 trillion. It would make up the majority of anyone's 40% in the traditional 60-40 portfolio that you hear about. Investment grade bond investors do not like risk or volatility. That's the whole point of investment grade bonds. They want stable, predictable returns, typically in the mid-single digits. As you can see in the next chart, Last year was a complete opposite. On average, investment-grade bonds lost about 13% last year, wiping out all of the gains achieved over the past few years combined. That's ugly. Going down to almost bottom of the bond market food chain is the high yield segment. These are bonds which are issued by companies that are more cyclical and have more volatile cash flows, which increases the risk of the bond investment. To compensate for this risk, the bond issuer must pay a higher interest rate to the debt holder. Typical companies in this segment are energy companies, material miners, and small cap, mid-sized issuers. 2022 was the second worst year since 1985 for high yield bonds. You can see in the chart you're looking at right now. The worst obviously being the global financial crisis when all velocity stopped for a very brief period of time. And then right after, it was one of the best years ever in high yield. It's all related to the velocity of capital and the interest rates. The bottom of the food chain in the bond world is the junk and distressed issuer debt. These are usually very small, undercapitalized companies which toe the line between solvency and insolvency. Total returns in this segment, as you might expect, are very volatile, with some very high returning years and others which are very poor in the case of last year. Predicting the bottom for bonds. Every crisis and subsequent recovery is different. Let's use historical bond yields to help paint a picture of where we are today versus historical bottoms. It's not foolproof, but it helps paint a picture. The chart you're looking at shows the historical yield earned for holding a debt instrument through to maturity or being called back by the issuer. Bond yield is a function of several things, namely the interest rate environment, inflation expectations, and the quality of the issuer. As you can see, the investment-grade bonds trade at lower yields than high yields and junk bonds, which we explained earlier in this missive. This makes sense as an investment-grade issuer will be more stable and safe, so they have to pay you less than the high-risk small caps that need to pay you more for your money. As you can see in the chart you're looking at, the cyclicality of the changes in yield. During times of duress, bond prices fall and yields increase. The yield increases because the issuer must compensate the investor appropriately for the market conditions. So basically, in good markets, yields are lower, bad markets, yields skyrocket. We can see that firsthand in 2002, 2009, 2016, and 2020, yields have begun to spike over the past 6 months, but we are still well below all previous peaks, put in at the worst times of the economic crisis. This is another sign to me that we have not hit the bottom of the market. But at the same time, I don't think we're too far away from the echo starting. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.